Hello, good afternoon, and welcome to a special online Paraplanners Assembly. If it's your first one of joining us, then welcome. It's good to have you along. If you haven't done so yet, at the top of your screen, kind of about there, there's a follow button. Please click that if you haven't done so already. That will make you follow us here in Crowdcast, and we can send you information, updates, and when we're going live, and all those kind of goodies that you love to get in your inbox. This is the first of a new series we're doing with Utmost. And it's going to be a three-part series coming up over the next 3 weeks or so, and we're very glad to have Utmost with us again. If you haven't done one of these before, these are very interactive. This one is a little bit different because we're going to go quite deep and technical on this one, but it is your chance to ask questions, interact, join in, so feel free to do that as much as you want to do. If we get questions that we don't get time to cover today, I'm sure Steve will be happy to follow up and we'll do a blog to catch up with those, but you can ask questions on the right-hand side of your screen. I don't know if this mirrors for me or not, but whichever way right is for you. Anyway, on the right-hand side of the screen, pop questions in the chat box there. Down the bottom of the screen, there's an ask a question button as well. You can pop them in there. I'll monitor those, keep an eye on them as we go. Feel free to chat amongst yourselves as well. That's entirely fine. We're going to record this as we always do, and there'll be a replay straight available straight away afterwards. And I'll post a link a bit later on towards the end, where you can see the video, get a copy of the slides and a copy of a CPD certificate as well. So all the goodies. So we're asked time and time again for help with taxes, and sometimes you want to go back to basics and sometimes you want to get a bit deep, and we're doing both of those today. And I'm very pleased Steve is along with us today. He's a long-standing friend of the Assembly, and so we're going to dive into the basics of UK tax, especially in the context of offshore bonds. So before we get started, Steve, would you like to introduce yourself?
Yeah, thanks, Richard. I'm Steve Sayer. I'm the technical sales manager at Utmost Wealth. I hope most of you will know of Utmost Wealth by now, but for those who don't, it's a company that was started in 2013, and by a series of acquisitions and organic growth, has grown substantially up to the present day. Some of the companies that we've taken over, if you're not familiar with Utmost, you will certainly be familiar with the companies we've taken over. People like AXA Isle of Man, AXA Ireland, Aviva Ireland, looking at, we've also completed the acquisition of the Equitable Life book of business, which was completed in January of this year. So we're a very, very large organization. We are based in the Isle of Man. We've also got bases in Ireland and in Guernsey. And predominantly our markets are, well, the UK, for the offshore type of investments for UK residents, but also increasingly so across Europe, offering products in many, many countries, in Spain, in Portugal, France, and a number of other countries. And also, of course, now going into the Middle East. We have a hub in the Middle East and also in Singapore. So we are becoming a truly global company. My role is predominantly based in the UK to provide technical support to our sales team, but I am increasingly getting involved in the Middle East and the Far East as well. So that's it. Sorry, Richard. Sorry to go on a bit too much about that, but hey.
If only we were allowed to travel to those nice exotic places, eh?
Yes, exactly.
Remember those days?
Yes, exactly.
So we're going to cover, I'll let Steve do the agenda in a second, but we'll cover things like an overview of the different taxes in the UK savings tax regime. We'll look at the structure of bonds and the taxation of bonds. We're going to bust a few myths along the way, and we're going to wrap up with some reasons to use an offshore bond. So we're going to go through slides which Steve's put together for us. There's a lot of information in these slides, and we're not going to go through it all today. The reason we've done it this way is we're going to make them available to you, and they're a great resource for you to go back to as part of your CPD, or if you're starting to do exams, what we're doing one very soon, around tax regimes in particular. So they're a good resource to come back to. All right. So if we get to a slide and you think, oh, I've been waiting for this, and we gloss over it, pop something in the chat room, and we'll pick up on it in a bit more detail a bit later on. So I'm going to bring the slides up on the screen now. While I'm doing that, Steve, here's a starter question for you. What are the main offshore bond jurisdictions? And is the Isle of Man in the UK or not?
Okay, well, the offshore jurisdictions, I think as far as the UK market is concerned, is one, the Isle of Man, two, Ireland, and then three, probably Luxembourg to a lesser extent. Basically, offshore jurisdictions are there to offer the possibility of gross roll-up, the ability to manage investments in a tax-efficient way. As far as the Isle of Man, the Isle of Man's an interesting jurisdiction in that it is not in the UK, but it is a crown dependency, which means that it is free to set its own taxes, its own tax regime, but it depends upon the UK for defence and certain relations as far as international relations go. I.e., there will be no embassies in the Isle of Man, for instance. But certainly the Isle of Man is not in the UK.
So are you in or out of the EU now?
Well, again, we were never actually, the Isle of Man was never in the UK, in the EU. It always had one or two special dispensations due to its relationship with the UK, but never actually in the EU. And of course, well, with Brexit, whatever's going to happen there, it will remain outside the EU.
Well, thank you. That's cleared things up for me. That's good stuff. Right, so I'll let you kind of take us through the agenda and then we'll crack on with the slides.
Yeah, okay, right. So the agenda today is, as you can see on the slide there, the session will go for a maximum of 60 minutes in total. And our aim is to give an overview of the structure of offshore bonds and their uses in the tax planning environment. Basically, what we look at, we'll start off with an introduction. Then we look at the structuring of bonds and how they can be, how they're used. Look at segmentation issues. Then look at taxation basics and be looking at various allowances, where bonds fit into the order of taxes and so on. And then finally look at one or two of the uses of bonds in tax plannings, and finally wind up with one or two questions, although please feel free to ask questions as we go along. And this is a starter, if you like, because next week we'll start covering more in-depth view of bonds, looking at the top slicing release in greater detail. So this is a starter, an introduction, but we'll be touching quite a few technical issues as we go through.
Top marks for you, because I forgot to mention that in the introduction. Next week is the deep dive. And then the third in this series, we're looking at how a bond is for lifetime and beyond as well. So don't worry if we don't get into too much detail on the particular things about top slicing when we do this session. That's all coming along. Okay, so if we go into the next slide then, Richard. Right, so where we're going to start at, we'll start at just an introduction, I think, and look at the different UK taxes. And I suppose when we think of the UK taxes, we think of, the ones that's on the screen there. You've got income tax, which of course we all hate paying, national insurance, VAT, corporation taxes. Then come, I suppose, the capital taxes, and we're thinking of capital gains tax and inheritance tax, I suppose, from a financial planning point of view, and then various green taxes. Now, the interesting point about those taxes is the actual amount of tax that they raise as far as the HMRC is concerned. And if we go on to that next slide, Richard, we can see the percentage that those tax brings in. So income tax is by far, far, far the most important tax in the UK, raising, well, just over 31% of the total UK tax take. And that's about 10% higher than the next tax, which is national insurance contributions, and roughly VAT, around about the same figures. Then comes corporation tax, which is substantially lower, and then fuel duties. And then only after that do capital taxes start to come into the equation. Raising in total, remember this is inheritance tax, capital gains tax, and stamp duty, only 5.04% of the total tax take. Now, the reason why I'm looking at the amount of taxes taken in the UK is because, as we all know, and we're all being affected by, we're in the middle of a pandemic. And the estimated bill for this coronavirus, well, it's been, I've seen estimates at 300 billion. I've seen one just recently at 350 billion. That really is there without taking into the effect there's the second phase. So what it's going to end up with, we just don't know. Now, the reason why that's important, of course, is because the debt that is being incurred by the government in funding
the various provisions to help people cope with the coronavirus, is going to have to be paid for by some method. And it could be deficit funding. The government could continue to borrow money as they have been doing. And that may be particularly attractive in the short term. But if interest rates were to start to rise longer term, then it could be maybe not quite so attractive. So what else could the government do? Well, I suppose they could reduce government spending. But we are, at the back of 8, 9, 10 years even of austerity measures by the government. Unemployment is going up. It's difficult to see how much extra austerity and saving in government spending they could actually make. And so I suppose the final alternative for them is to actually raise taxes. And again, if they raise taxes, we've got to ask the question, well, which taxes are likely to be raised? Now, it is important to note that the Conservative Party manifesto had made a commitment not to increase income tax and national insurance contributions. Now, whether or not they could stick to that with these, unforeseen circumstances is a question I just don't know the answer to. But nevertheless, what it suggests is that income tax, maybe the capital taxes are going to have to increase substantially, if not in the near term, but maybe in the medium to longer term, whatever we define that as, in order to fund for this deficit. And of course, if we are looking at situations where income tax could increase or the capital taxes could increase, then we are looking at a potential product that would enable that tax to be deferred or maybe avoided altogether. And such a product might be the investment bond.
Steve, I've had a question come in around this one. And if you can answer this, I'm going to be really impressed. Do you think without changing the whole chargeable event regime that the government could come after offshore bonds in isolation?
I think that's going to be extremely difficult because the whole chargeable event regime, which is contained in ITOIA, Income Tax Trade and Income Act, as you know, Richard, is legislated for both onshore and offshore bonds together. It's the same legislation that taxes both products. And I think it's going to be extremely difficult for them to do that.
Okay, that's good news. I can imagine that you can see how hard it is by putting handcuffs on income tax and national insurance. They've got to look elsewhere at breaking manifestos. And if you look at the politics of it, these easy offshore tax havens where millionaires stash all their money, you can see how that would play sort of from a PR point of view.
Well, I agree, and I think there's a certain it would be attractive for them if they could do it, but I think altering the legislation right across the board is going to be difficult. And the other thing, of course, is don't forget they've got no jurisdiction over the actual taxation in the Isle of Man or in Ireland. It's only maybe on final encashment that they could potentially look to raise the taxes if they could just tax the offshore bond differently. And then, of course, well, I suppose the savvy investor would come with ways of maybe mitigating that, such as assigning the policy to lower taxpayers, using things like the top slicing relief, maybe assigning the policies to non-UK residents. So there's lots of, problems that the government would have, I think, if they did try to tax the offshore bonds separately.
Okay, thank you.
Okay, right. So if we can go on to the next slide. So we mentioned that the offshore bond is potentially a way of mitigating that tax liability, or maybe a better way might be of deferring the tax liability. So the question then is what is an offshore bond? An offshore bond, at its very simplest, is a taxation and administrative wrapper. It's a product that will enable the individual to have more control of the taxation and when the taxation is due. And it's a product that also gives him greater flexibility in order to control what his underlying investments are and how they can fit, if you like, to his risk-reward profile. And as far as the offshore bond in general is concerned, it's very, very similar to an onshore bond, but it's potentially got, I think, greater flexibility in terms of the underlying investment choice. There's also a capital redemption bond, which removes the need for any lives assured and therefore gives 100% control over when an individual wants to trigger a chargeable event. And it also gives the opportunity for third parties, like professional external fund managers and money managers, if you like, to manage the underlying assets on behalf of the policyholder. So it gives an awful lot more flexibility going forward. And we can see that on the next slide, Richard.
Can I just pop a couple of questions to you, first of all, if we can?
Yeah.
We've got quite a few people that are relatively new or looking to get into paraplanning. So they may not have heard of the term of a highly personalized offshore portfolio bond.
Yes.
Which is different than the bonds we're talking about. Could you just sort of in like 15, 20 seconds to explain what a highly personalized bond is?
I could. I'm just wondering. Yeah, okay. Well, let's put the next slide up and let's try and explain it with the next slide. Okay. So just, I'll come back to that. So the offshore single premium bond, the investment bond, what is it? Well, as we said, it's an administrative stroke taxation wrapper where it can be, where the underlying assets of the policy can be linked to many different investment items, if you like. And primarily they're linked to collectives, such as maybe OICs, maybe investment trusts, maybe life funds. But in essence, what they can be, they can also be linked to assets that offer greater flexibility in terms of investment choice. And what they can be linked to is individual stocks and shares. Stocks and shares that are quoted on the main markets, you know, the FTSE, the New York Stock Exchange, whatever it might be. The problem there, of course, is that if the policy is linked to those more specialized assets, the individual stocks and shares, it's got to be the policy holder has not got to be able to influence the choice of the asset. Because if he were to do so, or were to have the facility of influencing the choice, if you're looking at individual stocks and shares, then the policy would fall foul of the personal portfolio bond regulations. Now, that sounds a bit of a mouthful, I suppose. What does it really mean in practice? Well, it means in practice, if an investment bond can invest directly into a portfolio of stocks and shares, and the policyholder can instruct the life insurance company to buy those individual shares, then there will be a deemed gain on the policy of 15% per annum. And that sounds pretty horrific, because that 15% per annum then incurs a tax charge as if it's a chargeable event. And obviously, as bonds are subject to income tax, that could give rise to a 45% tax liability on that deemed gain, even if the policy is standing at an actual loss. Now, it is therefore important that the policy, when it is issued, does not infringe those personal portfolio bond regulations. And the way that can be facilitated is that if the policy can invest or gives the policy holder the facility of investing in stocks and shares, then he cannot influence the choice. He instead, or the life company instead, has to appoint an external fund manager or discretionary manager to advise them on the individual assets that the policy should be linked to. The policyholder will have no influence whatsoever. And on that basis, it will not be deemed to be a personal portfolio bond.
Don't go with that, in other words. Stay away from them.
Well, exactly. Unless you've got an external fund manager, which is, you know, there's a great market for that type of thing. Or if you want the policyholder to have influence, then stick with collectives at all stages. So the offshore bond, what it does, it's actually linked to a number of assets, either chosen by the policyholder directly or by an external discretionary manager if the investment options are a little bit wider. And from those assets that it's linked to, it will receive income in form of dividends, maybe coupon from bonds, maybe interest from MOICs, maybe it's over 60% in interest producing assets, or maybe in actual rent. And those income will accumulate within this wrapper, which is the offshore bond, and no further tax will be paid at that point, as it's a gross roll-up vehicle. Now, once it's in there, there's a number of choices. Then the income can continue to accumulate in that tax-free environment. Or indeed, if the investor, the policyholder wants, he can take a withdrawal from the policy. And of course, we're all aware of this 5% per annum tax-deferred withdrawal facility that is in legislation. That is deemed to be a return of capital as far as the investor is concerned. And he can take that from the policy on a year-by-year basis. If he hasn't taken his full 5% per annum up until that year, then he can obviously make good, if you like, the withdrawals that he could have had. And there's two things about that 5% per annum withdrawal facility. First of all, there is no tax liability at the time of the actual withdrawal. And perhaps more importantly for a lot of clients, there is no need even for self-assessment on that withdrawal. So it can be very, very advantageous to them as far as their tax mitigation is concerned, but also as far as their general administration is concerned, not having the headache of completing or paying their professional advisors to complete their ongoing tax returns, as it were, on an individual basis. So that's one way of taking the benefits on the 5% on the regular withdrawal right across all the individual policies. There's another way of taking benefits from the investment bond. The investment bond itself tends to be segmented into a number of, if you like, mini policies. And we have here on the slide, we've got this investment bond that's segmented into 8 mini policies, just by way of an example. In fact, or in actual cases, you tend to find that the policies are segmented into many, many, many more policies to give investment flexibility, and flexibility as far as the tax planning is concerned, as far as the policyholder is concerned. And for as far as Utmost is concerned, we usually have a minimum of £500 per segment. So, you know, £100,000, you can have 200,000 segments and so on. Now, the reason why that's important is because it gives an extra option as far as the client is concerned. He can take a withdrawal across all those individual policies using the 5% that we've said, or he can actually encash a number of those individual policies. And we'll see as we go through the presentation the different tax effects that will have. Suffice to say at this moment in time that when you encash a policy, your tax liability is calculated with reference to the gain. And if you are a nil taxpayer, or perhaps you're non-resident, then potentially you might have no further tax to pay. If you're a basic rate taxpayer, maybe 20%, higher rate, additional rate, 40, 45%. But the important point there is because the bond is taxed as savings income, if you've got any allowances, and I'm thinking here of the starting rate band for savings or personal savings allowances, any gain from the encashment of those full segments can often fall within those allowances and make a very, very tax efficient way of taking withdrawals. Go to the next slide. So basically, as far as the bond is concerned, what we've got is we've got a structure that can help clients to mitigate income tax. It can help them to plan for the inheritance tax either now or at some stage in the future, because these things are freely assignable from individual to individual. It doesn't trigger a tax charge. It is a potentially exempt transfer for inheritance tax purposes, but it doesn't trigger an income tax charge on the disposal. It can be assigned to a trust, maybe for planning at a later date. And yes, you could have, a chargeable lifetime transfer going in, but you have nil rate bands that you can utilize. So very, very good for income tax, very, very good for inheritance tax, and very, very good for capital gains tax. Why? Because assets can be changed within the policy that the policy is linked to without any capital gains tax being incurred. So very, very good. So the UK savings regime, we said the bond falls into the UK savings regime. It's important when we consider the regime to look at the basic template. Because looking at the UK income tax position, income is taxed first and foremost on non-savings income. And then after that, it's taxed to savings income, and then dividends are taxed as the uttermost layer, if you like. So non-savings income are typically, earned income, income that arises in terms of rent, even distributions from trusts would be classed as income distributions from trusts would be classed as non-savings income. Savings income is the usual type of things. We're looking at interest there, but we're also looking at chargeable events, i.e. any gains that results on the encashment of an offshore life assurance policy. Dividends, of course, is simply dividends. And there is a strict order that those income, different levels of different types of income are taxed. And if we go into the next slide, Richard, you can, it might surprise you that there are 7 different levels of income tax in the UK. And so what we've got obviously basic rate tax to at 20%. Then we've got the higher rate 40 and the additional rate 45. But we've also got on top of that, we've got different rates as far as dividend income is concerned. So the 7.5%, 32.5%, 38.1%. As far as the dividends are concerned. But then we've even got another level of income tax, and that is 0. And I say it's 0 because there's one great, misconception as far as a lot of people are concerned, that when they look at some of the allowances that are available, and we're thinking of things like the personal savings allowance, the starting rate band for savings, and even the dividend allowance. They're not strictly allowances in the normal sense, in that they are taxed at the 0 rate, but they fall within the band, the income tax band of the investor. So they're using part of that investment, that income tax band up, but taxed at the 0 rate. So that's the final 7th, if you like, income tax rate. So to go on, what is a life assurance bond? What's capital redemption bonds? Well, it's investment bonds, offshore investment bonds. There's 2 types, you see. Life assurance bonds, and that they end on the death of the life assured. They can be first or second death or last death if there's multiple lives assured. Ours are all written on a last death basis. Now, the problem with a life assurance bond, of course, is that nobody can categorically ever say that all the lives assured won't die at the wrong time. I know that's a particularly awful way of saying it, and I do apologize because death never occurs at the right time, but it could trigger a chargeable event at the worst possible time for tax planning purposes. And so the alternative to a life assurance bond is this thing called the capital redemption bond. And the capital redemption bond, it's not a life policy as such. It has no lives assured, but it's taxed under the same legislation. It doesn't require human life to be a life assurance under it. It's simple an actuarial calculation. And the definition is on the next slide.
Steve, before we go there, can I just ask a question? How strict are the insurable interest rules for lives assured on a bond?
It depends. With the Isle of Man, there is no insurable interest rules, to be fair, but with other jurisdictions, there may be.
That's easy enough. Works for me.
Okay, good. So life assurance and capital redemption bond, Basically, this definition of the capital redemption bond, it's there. It's the business is a capital redemption business if it consists of the effecting on the basis of actuarial calculations and the carrying out of contracts under which, in return for one or more payments, either premium, a sum of a specified amount or a series of sums of a specified amount becomes payable at a future time. So what that means in simple English is if an investment is made in the capital redemption bond, the insurance company who is providing that policy has to give a guarantee that the policy will be worth a sum or a specified amount at some stage in the future. And what Utmost does with their capital redemption bond from the Isle of Man is they give a guarantee that the policy will be worth twice the initial investment in 99 years' time. Now, in terms of the actual worth of that guarantee, I mean, if the policy doesn't grow to at least twice its initial investment over a period of 99 years, you know, everybody will have withdrawn the money well before that, in any case, because of poor performance. But in terms of complying with the definition, then it makes sure that the policy is a capital redemption bond and therefore receives that special tax treatment that makes it taxed exactly the same way as a life insurance policy, but without no lives assured. Okay. So if we now go on to look at the structure of bonds, and go on to the next slide, please, Richard, and just look at one thing that does cause an awful lot of misunderstandings. Many clients and advisors, I think even, when they're looking at investment bonds, actually think that the investment bond owns the underlying assets that are selected by the policy holder or his or her, you know, or the external advisor appointed by the insurance company. Of course, in practice, that is not the case. What happens in reality is when the policyholder fills in an application form, he or she will select a number of assets, or if it's stocks and shares, an advisor appointed by Utmost in this case will select assets that the performance of their policy will be linked to. Now, the reason why that is important is because if the policy directly held those assets, then there would be no, effectively, capital gains tax deferral. And so we received the application form. The application form has issued or has stated the assets the policy is to be linked to. And then the policy will be valued in according with the underlying changes in the valuation of those linked assets and or any income that they produce. Now, of course, it is important, therefore, that as Utmost is giving that linked valuation, that it effectively matches its liabilities by having its long-term business fund buy those same assets. But the important point is the assets are bought by Utmost. The policy stipulates what the policy is going to be linked to. Utmost provides the valuation difference, if you like, and the policy does not hold the assets directly. And if you go on to the next slide, please, Richard, yeah? So you said if the assets were held directly, then the policyholder, well, would effectively not achieve his objective of being able to invest in this policy that defers tax liabilities. It's the matching mechanism that gives that facility. Okay. Now, the next thing about the structure of bonds is this one that we referred to earlier. This option, if you like, and this facility of segmenting the policy by issuing the whole investment, if you like, as a series of smaller mini policies. And here we have a policy that's issued as 10 mini segments. In practice, this could be many thousands of segments, because fundamentally what it does is it gives options as far as the policyholder is concerned as to how many policies he encashes, what's the gain on those segments. Does he want to encash one segment, 10 segments, 15 segments, and maybe take tax-deferred withdrawals across the remaining segments? He has the options, and the more policies that he's got, the greater will be those options. And on the next slide, we can see that, because of that, the policy itself can be often referred to under different terminology. Obviously, the one that we used to is a bond, but it can often be referred to as a wrapper, as a cluster policy. But all what they are is it's a policy that holds individual policies. And the beauty of that is it gives the choice as far as the client is concerned. Also, I suppose on the admin side, that last point there is important. That an individual may make a large investment. He may have a large number of mini policies. But as far as the paperwork is concerned, there is only a schedule issued these days. Gone are the days many years ago, thank goodness, where there was one piece of paper or one document for all the underlying policies. And the individual really ended up with a policy documentation about that thick. Now it is only issued as one schedule, so it makes life a lot simpler.
I remember those days.
Exactly.
Question for you, please, Steve. How do Utmost avoid paying tax on the investments if they're actually the ones buying them?
Because Utmost is based in this particular instance in the Isle of Man, and there is no tax on the underlying investments as far as the Isle of Man is concerned.
If only we could all move to the Isle of Man, but it's not as easy as that, is it?
Well, yeah, and of course there's a cost in terms of weather and all the extra costs involved getting on and off the island, and so on. But that's another story. Okay, so what have we learned so far in the bonds? Okay, the products are subject to savings rate of income tax, and they can be used as opposed by individuals, by trusts. They can use to mitigate IHT. The underlying assets that the policy is linked to is not subject to capital gains tax because of this linking mechanism, as opposed to actually holding the underlying assets itself. Obviously, the structures are looking at either life policies or capital redemption policies. Policies are issued in many segments to facilitate flexibility as far as tax planning is concerned. And the actual tax itself is contained, as it says there, Chapter 9, Part 4 of the ITOIA 2005, which is the legislation that governs both onshore and offshore policies. And basically, as it says there, the policy itself is all about tax deferral, giving the policyholder the ability of deferring tax, but also being able to choose when tax is paid, and at the same time then benefiting from the savings regime and things like top slicing relief, which we'll go on to next week. So basics on the tax. We've already said the policy is issued as individual segments. If we go into the next slide, we'll see the taxation of each policy segment. Basically, there's, I suppose, two events that we need to take into account. If there's a chargeable event, so when the policy is surrendered for a gain, or when there's a 5% withdrawal in excess of the deferred 5% entitlement, or the policy matures maybe, then the policy will come to an end. So the policy will trigger a chargeable event liability. And in which case, then you will pay tax on any gain that results. And that could be, if it's in excess of 5%, it could be the total excess that is subject to income tax. If it's on a encashment of a segment, then you would pay income tax upon the gain that is triggered. Now, where the policy comes into play is when the facility it gives the client where there is no chargeable events. So, i.e., we see that the policy is surrendered at the loss, there's no chargeable event, but also the main two, if you just press a button, please, Richard, is the policy can be gifted, and that could be to another individual, It could be into trust, maybe for inheritance tax planning. Or the policy can be partially surrendered, by which I mean the policyholder can make use of this 5% tax deferment entitlement, and that will not give a chargeable event. So it can become very, very attractive for the higher rate taxpayer, for the taxpayer who's able to make investments, who wants to control his tax liability, who wants to achieve gross roll-up, because on top of that, the policy will also give gross roll-up and the ability for either the policyholder or the external manager chosen by the insurance company to switch the investments to generate greater returns without triggering that tax liability. In calculating the chargeable event on an individual segment surrender, we use the tried and tested formula laid down in legislation, this A plus B minus C plus D, where A is the amount the policy has been surrendered, B is any previous withdrawals within the 5%, C is the premium that was paid originally, and D is any previous excess events, i.e. any withdrawals in excess of 5%. And if we use that simple equation, we will come up with effectively a potential liability, a chargeable event, a liability on a chargeable event that will be subject to tax. It'll either be a positive or a negative. If it's positive, then there will be a tax liability to pay. And I suppose we could look at that more better pictorially on the next slide, Richard. Partial surrenders, which are these 5% or 4% or even higher, are taken right across all the segments. And the important point there is that they are very, very tax efficient up to that 5% figure. Any withdrawal in excess of the allowable 5% times the number of years the policy has been in force, then is no longer tax efficient, because then the whole excess is subject to income tax. And it doesn't matter if the policy's been made a loss in the total benefits or not. The whole excess will be subject to income tax. So it's important to know the different tax treatment. 5% very tax efficient, but if you make an excess withdrawal, then you could give rise to an unforeseen and an unwelcome tax liability.
It's important to remember as well that since RDR came in back in 2013, I've forgotten about it now, that any bond set up since then, or any changes made to a bond, and you've got to look at the rules to work out what they are, then any facilitated advisor fees are included in that 5%. So if it's 1% fee, and the client's still taking 5%, that's a problem you're going to have pretty quick.
That's a problem, yeah. And it's a horrendous tax charge as well. Now, the alternative way of taking benefits from the policy is by surrendering whole segments, whole mini policies, and in which case there's a completely different calculation of the tax liability. And the tax liability is then calculated with reference to the gain using that formula we looked at previously, the A plus B minus C plus D, which if the client is taking total withdrawals in excess of the 5%, total benefits in excess of the 5%, then he is probably going to be better off by taking a combination of mini policy segment surrenders and withdrawals across the remaining segments. And coming back to previous slides, the facility that policies give by giving lots of mini policies makes this type of planning so much easier to give a good result.
You can build a really good spreadsheet using sort of goal seek functions to work out a combination of partial and full segment surrenders to work out the most tax efficient way of doing it. So hours of fun to be had doing that.
Well, the other thing, to be fair, Richard, is that if any of the paraplanners, any of the guys out there who come across Utmost policies, is that Utmost will actually help you to calculate the most tax efficient way of taking a potential lump of money from a policy. And we can actually help in terms of the number of segments and the remaining partial withdrawals to give the best tax outcome.
Yeah, I could just endorse that. We've got quite a few advisors that use Utmost Bonds, and knowing we can get that facility. The document you produce is really good and readable as well, which makes a change. So yeah, we like that.
Glad to hear that. Good. Right. So just to recap on the tax rates, we've already said that the bond is subject to savings income. So it's that level above the non-savings income. And because of that, and because it's offshore to cheap gross roll-up, it makes it ideal for clients or policyholders who want to utilize any personal allowances that they may have. The starting rate band for savings, personal savings allowances, £1,000, £500, whatever it may be. Because obviously they're a cheap gross roll-up in the product. And if they're making an encashment, a surrender at a gain, and that gain falls within their personal allowances, then effectively they've not only had a gross roll-up, but had proceeds, or some of the proceeds free of tax as well.
Yeah, another really good comment actually in the chat room, which I should have mentioned earlier on, is that most advisors take their fee as a percentage of the current value of the bond. Whereas if you're going for the tax-deferred withdrawals, it's capped at 5% of the original amount invested.
Original amount, yeah, you're absolutely right, Richard. Yeah.
You could actually creep over that, which is a nice problem to have, I guess, but it's still a problem.
Yeah. And on to the next slide, looking at those tax bands in a different form. I suppose if you add the personal allowances together for an individual, then we're potentially looking at tax-free income of up to £20,500 that you can take from various sources without paying any tax liability whatsoever. And of course, as I said earlier, using a bond that will fall, use of personal savings allowances on the next slide, Richard, can actually help that. So again, the starting rate band of 5, the personal savings allowance of 1,000 or 500, whatever it might be, you can actually use that with the bond itself, which is really good. And then combining that with, of course, things like top slicing relief as well, just makes it even better.
We've touched on top slicing a couple of times, and if you're really itching to get into that one, then next week we're going to really sort of scratch your itch on that one. So we haven't really talked about it yet. Top slicing can be a very good friend to actually help minimize or mitigate some of the tax, but we'll cover that more next week.
Okay, good. Yes, we will. Right, so we just look at one or two of the potential markets for offshore bonds this week, and then I think we're getting towards the end. So one or two myths, and I think it's important just to have a look at these because clients do believe some of these things. Offshore is aggressive tax planning. Offshore can be aggressive tax planning. It really does depend on what you're trying to achieve. But in terms of an offshore investment bond based in one of the jurisdictions I've already mentioned, well, let's say it uses the same legislation as onshore bonds. It's widely available. They've been around in their current form for many, many years. And in fact, we need to report under the CRS and FATCA. And it's not covered under the disclosure of tax avoidance schemes. I said they're widely accepted as far as the revenue is concerned, and in no way are they aggressive. So that can give an awful lot of comfort in that one. Products are complicated and expensive. I suppose in the early days, maybe there were, but in terms of the market as it is now and how the market has got really competitive, I don't think they're no longer expensive. They're very, very cheap and offer really good value for money. And I don't think they're necessarily complicated. They can give solutions to complex situations, but the products themselves are not complicated. They're a simple wrapper that is the underlying investments, that's linked to underlying investments, that the client can be as sophisticated or not sophisticated as he wants to be, and he can be as risky or as risk averse as he wants to be. Surely UK residents can't invest offshore. Well, quite clearly they can, and they do for lots of very legitimate reasons and for very, very good tax planning and investment returns. So on the next slide, reasons to consider offshore bonds. Well, they're manifold. We've already looked at UK tax management, the tax deferral that the bond gives. We've looked at the tax efficient withdrawals, whether it's under the 5% or a combination of segment surrender and maybe the 5% if that gives a better outcome. We know the product gives gross roll-up, and gross roll-up, in my way of thinking, means enhanced returns as far as the client is concerned. We know the product can offer things like open architecture, can offer links and the facilities of external discretionary managers to manage the investments on behalf of the insurance company, thereby opening up the field as far as the linked investments are concerned. And obviously, the more scope, the bigger that potential investments, then the bigger is the potential return. As far as trustees are concerned, bonds tend to form a lot of discretionary trustee investments, and quite simply, they give gross roll-up as far as the trustees are concerned, solving in the meantime lots of problems, such as things like the tax pool. You know, there's a situation where trustees receive dividends, which is net of the 30 and pay tax of 38.1%. But if they distribute that income to beneficiaries, they have to distribute it with a tax credit of 45%, because it's a rate applicable to trustees. And therefore, you've got this mismatch, I suppose, in terms of tax liability. A bond will solve that. It is non-income producing. The trustees do not pay tax on the income that the bond receives on its linked investments. And so it can be very, very tax efficient as far as trustees are concerned. UK resident non-domicile, because it gives gross roll-up, and it gives them the facility of paying tax when they choose to, or more probably have taken the policy with them when they leave the UK. People who spend time outside the UK, maybe through work, maybe through, I don't know, going abroad to live for a number of years. Maybe they decide to retire abroad and then come back to the UK. Well, they can benefit from things like time apportionment relief. Inheritance tax planning. Why? Because bonds are easily assignable, either by direct gifts to an individual or maybe a settlement onto a trust. Clients who have exhausted dividend allowances, this £2,000 a year. Well, if they're a higher rate or an additional rate taxpayer, the last thing I guess they're wanting is further an income tax liability. So by investing in an investment bond and linking its assets through to dividend-paying assets, then effectively they will have no further tax liability at that time. And we could go on to look at retirement planning and school fees planning, but you know, they can be very, very attractive as far as the clients are concerned. In terms of tax management, just a couple of words on there. You can have either cap redemption bond, which gives you 100% control of any when a charge event will occur, or you can have a life assurance policy. Either or, Utmost offers both. Why would clients have a life assurance policy over cap redemption bond? Well, it might be the case if they're going to move into some jurisdictions, the cap redemption bonds aren't recognised. So life assurance may be better for those type of clients, but it's on an individual by individual basis. There's obviously, we said gross roll-up. The bond is non-income producing, so it doesn't give, it doesn't add to their ongoing income tax liability. It offers gross roll-up, no CGT on switching the underlying linked assets. They've got its 5% tax withdrawal allowance, so you can use it. And you don't use it in year one, you can have 10% in year two, and so on. You can combine that with segment surrender to give you the most tax efficient way of taking benefits. You can assign the policy or just individual segments of the policy to an individual, father to son, for generational planning or onto a trust. Self-assessment friendly. If you're not taking benefits from the policy or the benefits you are taking fall within those 5%, you don't even need to self-assess. So for the clients who are tired of the paperwork that March or January, January tends to produce, well, this is one way of potentially reducing that paperwork somewhat. And it's great for inheritance tax planning.
If it's okay with you, next slide is about investment opportunity, but we're a bit tight for time.
Yeah.
You say that you've got access to loads of stuff, basically, with an offshore bond. So that's never a reason not to use one. It'd be great if you could just talk through the last couple of slides we got, which I think would be really useful. Start with the trustee one.
Yeah, okay. So just to go along a little bit further on that trustee situation, why bonds are attractive for trustees. Well, basically, if the trustees are investing in a capital redemption bond, well, it gives them certainty as to the timing of any tax liability. Um, and basically, it means that they can keep the investment going as long as they want. They can effectively transfer or assign the policy out of trust to the individual beneficiary. And the beauty of that is, instead of the trustees then be liable to tax on the chargeable event at what would have been 45%, if the policy or the segments of the policy are assigned to beneficiaries, it's the beneficiaries that's going to be taxed on their encashment of the policy. And of course, their tax liability might be considerably less than 45%, but also as an additional benefit, they can use top slicing relief as well. We've already said about dividends and incomes that trustees receive, dividends where they pay tax at 38.1%, and this mismatch, if you like, on income paid out to beneficiaries. The policy can solve that conundrum because there is no income being paid to trustees, so they don't have to account for that tax as far as the tax pool is concerned. The policy itself is non-income producing, so it eases the burden of the administration on the trustees. And because it's open architecture, which was that slide that we rushed past where Richard said there's loads of things it's linked to, invest where you want almost, it help the trustees meet the criteria of the Trustee Act 2000. They have a wide range of assets that it can be linked to. And then finally, on inheritance tax planning, well, for the policy is really quite good in these situations, either for clients who want to plan now, or more likely perhaps clients who want to plan in the future. Because if the client's UK resident, non-domiciled, then he can use the policy now, maybe for things like excluded property trusts. And that has an advantage because then he's looking at the excluded property trust, which is an offshore trust. He's investing in a policy, achieves gross roll-up, and maybe he can assign that policy to a beneficiary or to himself when he becomes non-UK resident. He can, if he has a policy now, maybe he can assign that policy into trust at some stage later with no implications as far as capital gains tax is concerned, unlike the situation if he invested directly in assets. It would be a CGT on disposal. Obviously, potential tax efficiency, we've said that with discretionary trusts already. The capital redemption basis, which we know gives the guarantee that there will be no enforced charge event. And for clients who are risk averse, the policy offers good inheritance tax planning opportunities in the sense that they can assign the policy onto trust or by way of gift at some stage in the future, i.e. if they're looking at other investments, maybe assets that qualify for business relief, then that may be a little bit too high risk for those type of clients. So lots of opportunities as far as inheritance tax planning is concerned.
Thank you, Steve, and thank you for letting me whiz over that slide. We've got a couple of questions to finish on. Then I'm going to post a link in the chat room for you to get access to slides and CPD for this one. So the first one is there any reason why the Isle of Man and Ireland are the most common for offshore bonds in the UK? Is it just because they're close?
Well, I don't know, really. I mean, historically, I suppose because the English language would probably be one of the main elements. Because it gives not only English language, in the sense of the policyholder is concerned, but to speaking with English speakers in the Isle of Man and Ireland, and they offer gross roll-up. So yeah, I think that's one of the reasons. The other reasons is the Policyholder Protection Acts are very, very strong in those jurisdictions, and certainly a lot higher than some of the more warmer jurisdictions. Should we put it like that?
Aaron's gone on to mention our old friend Brexit, that could be making Ireland not so attractive because of VAT and compensation. Aaron, there's a really good thread on the Big Tent that was started by Dan Atkinson earlier this year on when it became obvious what's going to happen. If you search on the Big Tent, some really good stuff on there. And I think actually we've got some links off to some stuff from Utmost in there as well around that one. So have a look on there. And the last quick question is coming from Andrea, and that's: given the chancellor's need to replenish the coffers, are you aware of any consideration being given to dispense with the 5% tax deferral?
None at all. No, I mean, no, not as far as I'm aware.
It goes right back to the start. That would mean a whole rewrite of the whole child.
Absolutely right. Yeah, absolutely right. And it would have a great effect upon lots of existing policyholders who form a large proportion of the UK population, I guess. Yeah,
exactly. Right, so I've just popped a link in the chat room. If you go there, you can get a copy of the slides. A copy of the video will be there soon as well, and you can download a CPD certificate from Utmost. Steve, thank you so much for that, and thank you to Utmost as well for supporting the Power Planners Assembly, as you've done for several years now. Without your help and support, we couldn't do what we do, and we couldn't have you, of course, which is really useful to our community. So if you want to keep the conversation going, pop on the big tent. I said there's some good threads already around offshore bonds and Brexit and compensation schemes and all those kind of things. We are back again on the 21st, which is a week tomorrow, in my head anyway, where we're going to do a deeper dive into the whole tax regime. We'll look at top slicing, we'll look at the silver case that's happened quite recently. Go onto our website, look under the events, you can save a spot for that one if you haven't done so already. I'm actually back tomorrow at 1 o'clock, where we're looking at ESG and SRI, and all the jargon, which I can't even say these days. And we're looking at it from a power planner's perspective on putting together and building an investment proposition that ticks all those boxes. And so we'll join you then if we can. Don't forget the Landcat run their home games every Wednesday, 12:30. Lots of fun and games going on there. So join that if you can. Thanks for your questions and participation. Thanks again to Steve. And we'll be back. What a double act we are. We'll be back next Wednesday at 1 o'clock with a deeper dive into bonds. Thanks, everyone. And we'll see you again soon.
Okay, thank you.
Bye.